Shelby, has the U.S. consumer been misdiagnosed? And I say that because they're completely contrasting views when one takes a look just on an equity basis here. Then there's the numbers that you see out of the likes of Walmart, McDonald's, Starbucks seeing some weakness, McDonald's obviously seeing some weakness there too. Then you have Lowe's, of course, and some of the other home companies as well, where things also look a little bit different. Are we seeing just too much contrasting views on the retail space and the consumer, especially then when you take a broader view and see that retail sales number?
hmm I think when we look at the US consumer, it's a classic case of diagnosing maybe a discretionary problem and not popping the hood and seeing the staples issue beneath. So when we look at Walmart, the fact that they do offer so much value, one of the reasons that they're doing so well is because they're able to price efficiently the things that consumers need, and they are now capturing all parts of the income structure. But then when we go ahead and look at those names you mentioned, Starbucks, Lowe's, Home Depot, we're now starting to separate into two different types of discretionary, one of them being sometimes more expensive hard lines, and then looking at Starbucks, and that's a bit more of a treat, but it's something that does add up. And so when you're looking at these places that start to sort of fall out of the budget spend when things get a little bit tight, it's harder to use those to completely diagnose how the consumer is faring. And then we do still also need to look at how those businesses are run. So one of the reasons that Starbucks may be struggling a little bit in the equity department, or even Target, is going to be quite different than Lowe's and Home Depot. Some of those things are going to come from management and their offering of value versus the overall sort of macro situation being tighter budgets, less real spend, and higher rates.
Shelby, we've seen economic cycles before, and the reality is there's a difference between managing down spending and keeping your spending alive versus completely shutting the wallet when you lose your job and when also you cannot pay back key loans that are due. Just talk to us about that cycle, whether we're anywhere near that worst case scenario.
I think at this point, the data doesn't point towards being in that worst case scenario. We have seen some tightening in sort of the white collar corporate job market. We're seeing a lot less shuffling as some of those options are fewer than they were in 2020 and 2021. But it does not yet appear, even with those tightening unemployment numbers, that we are quite at that point where individuals need to completely shut down. The financial institutions have not yet indicated that sort of debt service is in crisis type straits. So that's definitely positive. We're grateful to definitely just see the sort of turn down in discretionary spend. And that's something you want to see. That's a healthy behavior that we want to see in a business cycle so that we don't sort of go off of that cliff. And so that customers can, or consumers rather, can continue to use small amounts of credit if need be. And so we do continue to watch sort of the payment networks as well, looking out for when even credit spend starts to turn away from what we want to see.